Welcome back as we dive deep into Chapter V of The Infinite Investor. So, we've got our investment buckets all set up, but now what? How do we actually decide what goes in them? Well, today we're going to unpack a really powerful framework for making those critical decisions.
All right, so let's get right into it. You've probably heard all the old rules, right? Stick to a 60-40 portfolio, rebalance every quarter. The book makes a really strong point here. These rules are just, well, they're blunt instruments. They're designed for a nice, predictable world that, let's be honest, just doesn't exist for investors. They act like the path you take doesn't matter, as long as you get there. But for us, the path is everything.
So, what's the alternative to these rigid rules? The book gives us this amazing new toolkit. It calls the 5 lenses of calibration. And the key word here is lens. A lens isn't a rule telling you what to do, it's a question you ask yourself. It's like putting on a different pair of glasses to see a decision from a new angle. And when you use all 5 together, suddenly it becomes crystal clear whether what you're about to do actually helps you or hurts you in the long run.
And here they are, the 5 lenses. You've got ergodicity, duration, power law, harvesting, and behavior. Now, this is super important. These are not a checklist you go through one by one. Think of them as 5 different camera angles you're looking at all at the same time. Today, we're just going to focus on getting really comfortable with the first 2.
All right, let's jump into lens number 1. And honestly, this is the big one. It's called ergodicity. You can think of it as the absolute foundation for everything else, because it all boils down to one simple, crucial idea: survival. And this is the question, the master question. Can I survive this decision? It has total, absolute veto power. I mean, think about it. If you make a move that wipes you out, what good is anything else? Your amazing strategy, that huge potential return, it's all gone. You are literally out of the game. What this lens does is it completely flips your focus. Most people jump straight to, okay, what's the expected return on this? But for real-world investing, that's the wrong first question. This kind of thinking, which the book calls non-ergodic thinking, starts somewhere else entirely. It asks, what happens if I'm totally wrong about this? It forces you, right from the start, to look at the worst possible path, not just some nice, clean average. Yeah, this table really nails the difference. Let's look at that first example. You have a stock that's either going to double or it's going to go to zero. The traditional ergodic way of thinking looks at the math and says, hey, that's a 50% expected return. Let's do it. But the non-ergodic investor stops. They see that goes to zero part and ask a totally different question. Can I survive that zero? See? It's not about the average outcome. It's about surviving the possible outcome. Okay, so this sounds good in theory, but how do you actually use this? Well, it boils down to 3 things you can do right now. First, your position sizing. Look, if a 5% position goes belly up, it hurts, but you'll live to fight another day. But if a 40% position goes to zero, that could be game over. Second, stay away from leverage. All leverage does is take a temporary dip in the market and turn it into a permanent loss you can't come back from. And third, you have to see the hidden connections. Thinking you're diversified because you own 10 different tech stocks is a trap. If they're all just different flavors of the same bet, you're not diversified at all. So this becomes your ultimate filter. Before any big move, you just ask yourself, if this thing goes to absolute zero, am I still in the game? And if the answer is no, you walk away. That's it. End of story. I don't care how amazing the upside seems. Survival gets the final say. It has veto power. Okay, so once we've passed that first critical test, once we know we're going to survive to play another day, we can move on to the second lens. And this one is all about time. We're talking about the lens of duration. Now, this idea originally comes from the bond market, but you can and should apply it to literally everything you own. And the question it asks is so simple but so powerful. When does the cash arrive? How long do I have to wait before this thing I own starts giving me actual, real cash back? And when you start looking at things this way, you realize there are basically 2 flavors of assets. On one hand, you have short duration assets. Think of stable, dividend-paying stocks. They're giving you cash now. They're not as affected by interest rates, but they can get disrupted by new technology. Then you have the long duration assets, your classic growth stocks. They aren't paying you now. They're promising a huge payday way down the road. And because their value is so far in the future, they are incredibly sensitive to interest rates. And the key here isn't to choose one or the other. No way. The real magic happens when you own both. You want a balance. You've got your short duration stabilizers, like a Berkshire or a Walmart, that are like a cash machine, just churning out money for you today. And what do you do with that cash? You use it to fund your long duration, explosive growth bets. The portfolio starts to finance itself. It's a beautiful thing. But here's where it gets really interesting. Every once in a while, you find a company that is the best of both worlds. A company that is its own cash engine and its own growth engine, all under one roof. These are these super rare, incredibly valuable, dual duration companies. Think about it. Look at Alphabet. Their search business just prints cash day in and day out. That's your short duration engine. Then they take that cash and pour it into these massive futuristic bets like Waymo and DeepMind. That's long duration. Amazon's the same. AWS is a cash cow, and they use it to fund everything from AI to new markets. What they're doing inside their own company is exactly what we're trying to build in our portfolio. That's what makes them such powerful compounding machines. So, let's recap. We've got two incredibly powerful questions now. The ergodicity lens makes sure you stay in the game, period. And the duration lens helps you build a portfolio that's balanced between the present and the future. But we're only 2/5 of the way there. The framework isn't complete yet. So in our next deep dive, we're going to tackle the final three. We'll get into the power law, which is all about making sure you have a shot at those life-changing winners. We'll talk about harvesting, which asks the tricky question of when you should actually take some profits. And finally, maybe the most important one, behavior. How to make sure you aren't the one who messes it all up. But let's leave it there for now. And I want to leave you with a question to chew on. Now that you know about ergodicity and duration, I want you to go look at your own portfolio and be really honest with yourself. Ask yourself this: is what I've built designed to survive anything, or is it just built to chase returns? Seriously think about it. The answer might just change everything for you.